Right now, the single biggest bottleneck to the future of AI isn't a lack of smart coders. It isn't a lack of VC funding. And honestly, it's not even a lack of those incredibly expensive microchips everyone's constantly talking about.
Right.
It's glass. It is literally the physical, actual glass tubes buried underground that are rapidly approaching their breaking point under the sheer, unimaginable volume of data we're trying to push through them.
It's a really fascinating paradox, honestly. We have this collective hallucination that the cloud, and by extension AI, exists in this sort of ethereal, weightless space.
Like it's just magic Wi-Fi.
Exactly. But the reality is that the artificial intelligence revolution is the most aggressively heavy industry, resource-intensive, physically constrained undertaking of our lifetime.
Which is exactly why we're doing this today. Welcome to a brand new deep dive. And if you're watching the AI space right now, you're probably hyper-focused on the software. You're looking at the new generative models, the chatbots, the video generators.
Mm-hmm.
But today, our mission is to uncover the invisible heavy metal infrastructure powering all of that. We're looking at the actual pipes.
Yeah.
Because you just cannot understand the future trajectory of AI without understanding the physical laws governing how data moves.
And those constraints are becoming severe. I mean, we are hitting the limits of material science, we're hitting the limits of municipal power grids, and quite literally, we are negotiating with the speed of light.
Right, so to unpack all of this, we aren't looking at a software release today. The source material we're analyzing is the Q2 2026 earnings call of Ciena Corporation, ticker symbol CIEN.
Yeah.
Now, for those who don't spend their days reading telecom supply chain reports, Ciena is one of the undisputed global leaders in optical networking equipment, software, and services. We're unpacking the insights from their top executives, so their president and CEO, their chief financial officer, and their executive advisor.
And earnings calls for infrastructure companies like Ciena are just incredibly valuable because they act as the ultimate leading indicator.
Yeah, they really do.
They're the canary in the coal mine for the entire technology sector. Long before a consumer ever gets their hands on a faster AI app, the infrastructure has to be purchased, manufactured, and bolted into the ground. Ciena sees the demand years before we see the end product.
Okay, let's unpack this.
Yeah.
Because the scope of the quarter Ciena just reported is honestly staggering. When I first looked at these numbers, I actually had to double check to make sure it wasn't a typo.
Yeah, I had the same reaction.
It's not just a financial report.
Yeah.
It's a real-time roadmap showing how the physical world is being bent to accommodate artificial intelligence.
And we should establish right away why this matters to you, the listener. Every time you ask a large language model to, say, summarize a PDF or you generate a complex image, your prompt doesn't just sit on your laptop.
Right.
It shatters into a million pieces, travels at a fraction of the speed of light across states or oceans, gets processed across thousands of parallel graphics cards in a building the size of a shopping mall, and then rockets back to you. The hardware that facilitates that travel is what we're looking at today.
So let's start with the sheer financial velocity of this shift, because you have hyperscalers and these new AI startups spending billions of dollars.
Yeah.
But what exactly are they buying? And more importantly, how fast are they buying it?
Well, the headline numbers from Ciena's Q2 immediately demonstrate a structural earthquake in the tech industry.
Yeah, they do. Let's do a quick talk ticker style rundown here for the folks holding or looking at the stock. We want to be data forward, keep it plain language, and give you the actionable bottom line.
Love it.
So to put it in perspective, hardware companies that have to forge metal, draw glass, assemble circuit boards, and ship them across oceans, they're historically slow growth entities.
Very capital intensive.
Right. They don't usually experience hockey stick growth curves like a software app going viral. There's physical friction.
Well,
but look at these numbers. In Q2 of 2026, Ciena's revenue hit a record $1.57 billion.
wow.
That is up an astounding 40% year over year. They beat their own internal guidance by $71 million.
Which is huge.
To achieve 40% growth in physical networking equipment in 12 months is almost unheard of at this scale.
It really is, but the top line revenue is only the beginning of the story.
Okay.
The profitability metrics are what really reveal the underlying market dynamics here.
Exactly. Let's look at the bottom line. Their adjusted earnings per share, the EPS, came in at $1.64. That is nearly 4 times the figure from the exact same quarter last year.
Quadrupling your earnings per share in a single year.
Yes. And the adjusted gross margin expanded to 44.9%, which is a full 4 percentage points higher than the previous year. If you're asking for my opinionated take right out of the gate, this is a massively bullish signal.
Oh, absolutely. That margin expansion is the critical piece of the puzzle. It completely redefines the narrative around hardware commoditization.
Well, and this is exactly where I want to push back, or rather where I think we need to really drill down into the mechanics. Because if you look at historical tech cycles like the personal computer boom or even early smartphones, the hardware eventually becomes a race to the bottom.
Right.
Gets commoditized. It's the classic picks and shovels play.
Sell shovels during a gold rush.
Exactly. But eventually there are 10 different companies selling shovels, and the price of a shovel drops to practically nothing. So in a world of persistent supply chain constraints and general inflation, how is a physical hardware company not only scaling revenue by 40%, but drastically improving its profit margins at the same time? How do they beat that commoditization trap?
What's fascinating here is that it comes down to two very specific economic forces acting in tandem: operating leverage and ruthless engineering cost reductions.
Okay, break those down.
Let's do operating leverage first, because it's vital for understanding how a mature industrial tech company can suddenly behave like a hyper-growth software startup.
Right. And operating leverage essentially means your revenue is growing faster than your operating expenses. It's the ratio of fixed costs to variable costs.
Precisely. Think about Ciena's underlying business. They have massive fixed costs. They operate sprawling, state-of-the-art research and development labs. They employ thousands of some of the highest-paid optical physicists, hardware engineers, and software developers in the world.
Not cheap.
Not cheap at all. Plus, global corporate headquarters. All of those are fixed costs. They have to pay those bills whether they sell one optical switch or 10,000.
So once those fixed costs are covered by your baseline revenue, any new revenue you bring in is incredibly profitable.
Exactly.
Because you don't have to hire a second CEO or build a second R&D lab just because Google doubled its order for optical lines.
That's it right there. A massive percentage of that incremental revenue from the AI boom drops straight through the income statement down to the net profit. That is operating leverage in action. The CFO specifically called this out, noting that even though they're paying out significantly more in variable compensation because their sales teams are obviously crushing their quotas and earning huge commissions, the fundamental operating leverage of the business is so strong that it absorbs those costs easily.
Okay, but operating leverage only explains why the net profit goes up as a percentage. It doesn't explain how they expanded the gross margin on the actual physical boxes they're selling. You mentioned engineering cost reductions.
Sure.
Are they just finding cheaper raw materials?
No, and that's the beautiful part of their strategy. When you are the undisputed technology leader and a critical choke point of the global internet, you possess immense pricing power.
Okay.
Ciena isn't just selling dumb glass cables. They're selling highly complex, intelligent optical routing systems that manage the flow of traffic. The software embedded in these physical boxes is just as important as the lasers.
So they're selling an incredibly profitable product mix.
Yes. The hyperscalers are demanding the absolute bleeding-edge technology to connect their AI data centers. They want the highest capacity, the lowest latency, the most power-efficient systems. Ciena charges a massive premium for that top-tier technology.
Right.
Meanwhile, internally, Ciena's engineering teams are constantly finding ways to optimize the manufacturing process for those systems. They design custom silicon that replaces multiple off-the-shelf components. They reduce the number of parts needed to assemble a switch.
So it's a pincer movement on profitability.
Exactly.
On the sales side, they're utilizing their market dominance to command premium pricing for next-gen tech. And on the manufacturing side, they're meticulously engineering the cost out of the assembly process.
That perfectly explains how the gross margin balloons to almost 45% even with inflation in the broader economy.
And the structural efficiency is also showing up in their liquidity, right? We have to talk about the cash conversion cycle.
Oh, yeah.
The source highlighted that their cash conversion cycle improved by 20 days just since the first quarter, which led directly to a free cash flow generation of $219 million in a single 3-month period.
Huge.
And for those who might not spend their weekends reading corporate balance sheets, the cash conversion cycle is essentially a measure of how fast a company can turn its raw inventory back into cash.
Yeah, it measures the time between when Ciena pays its suppliers for a raw piece of silicon and when Ciena actually receives a check from a cloud provider for the finished installed optical system.
And shaving 20 days off that cycle is like finding a massive pile of money in your couch cushions.
It really is.
In hardware, cash is oxygen. If you have $1 billion of lasers and circuit boards just sitting in a warehouse, that's dead capital. Improving this metric by 20 days means they're getting their equipment out the door, into the ground, and getting paid with extreme efficiency. It proves that this demand isn't theoretical, it's real, and it's urgent.
The foundational takeaway from these headline numbers is that the physical build-out of AI is not going to be a low-margin, commoditized race to the bottom. At least not for the companies that control the foundational technology. For the market leaders, this is a highly lucrative era.
Which begs the question, how big can this era actually get?
Right.
Because that massive 44.9% profit margin isn't happening in a vacuum. It's only possible because the sandbox they're playing in is expanding at a rate that allows for this kind of premium pricing. Let's look at the total addressable market, or the TAM.
Yeah, the TAM is the lodestar for any growth narrative. It tells you the absolute maximum ceiling for a company's revenue if they were somehow able to capture 100% of the market they operate in.
And Ciena's ceiling just got blown wide open. According to the executives on the call, they expect their addressable market to roughly double over the next several years. They are forecasting a TAM of approximately $50 billion by the year 2029.
$50 billion.
It's staggering.
That is a breathtaking amount of capital expenditure being directed specifically at network infrastructure over a very compressed time horizon of just 3 to 4 years.
And to really grasp where that money is coming from, we have to look at the customer breakdown. In Q2 alone, Ciena's direct cloud customer revenue grew by an astonishing 70% year over year.
Wow.
In fact, 2 individual cloud providers each contributed over 10% of Ciena's total revenue for the entire quarter.
And they traditionally don't name these customers for competitive reasons, but I mean, the math is straightforward. When you see 2 entities making up that much of $1.5 billion quarter, you're looking at the apex predators of the tech ecosystem.
The Googles, Microsofts, Metas, or Amazon.
Exactly. The level hyperscalers.
But the source material also highlighted something entirely new. During the Q&A session, the executives repeatedly used a term I hadn't heard before. They called them neoscalers. And they noted these companies are operating right alongside the traditional hyperscalers. I want to pause here and dissect this. What exactly is a neoscaler, and why do they warrant their own specific classification in a financial report?
It's a crucial distinction, actually, and it explains a lot about the changing architecture of the internet. To understand the neoscaler, we first need to break down how that $50 billion TAM is actually divided. The CEO, Gary Smith, explained that about 8 to 10 billion of that TAM will be what they call scale across.
Scale across, meaning horizontal connections between distinct physical locations.
Exactly. This is the heavy lifting of connecting massive data centers to each other over hundreds or thousands of miles. The rest of the $50 billion TAM comprises traditional wide area networks, or WANs, and the exploding market of intra-data center interconnects.
Which are the microscopic but vital optical connections inside the 4 walls of a single data center building.
Right. So you have the long-haul macro connections between cities and the short-haul micro connections inside the server farm.
Okay, I'm with you.
Now look at a traditional hyperscaler like Google or Meta. They have been building these macro and micro networks for over a decade. They employ literal armies of network engineers. They lay their own proprietary submarine cables across the Atlantic Ocean.
Right.
They have immense institutional knowledge of how to build bespoke optical networks.
So they're massive, powerful, but maybe a bit bureaucratic. They're like the aircraft carriers of the internet.
The aircraft carriers, exactly. But the sudden explosion of generative AI has created a totally new class of company, the neoscaler. These are the next tier of aggressively fast-growing tech companies. They might be building foundational AI models or offering specialized GPU cloud services to other developers.
Like an Anthropic or a CoreWeave?
Exactly. They have raised billions of dollars in venture capital, and they need to scale their infrastructure with violent speed to remain relevant.
Right. Because if you're an AI startup that just raised $4 billion to train a new foundational model, you are on a ticking clock. Your investors want a product yesterday.
Precisely. And here is their primary dilemma. They lack the decade of infrastructure experience that a Google has. They don't have thousands of dedicated optical network engineers on payroll. They're trying to move at light speed, but they just don't know how to physically wire together a supercomputer spread across 3 different states.
And that is where Ciena strikes gold. Because a neoscaler can't just buy the individual lasers and glass tubes and figure it out themselves. They need someone to build the entire nervous system for them.
You've hit the nail on the head. Ciena isn't just selling hardware to the neoscalers. They are selling a fully integrated turnkey solution.
Oh, wow.
They design the network architecture, they provide the management software, they install the physical equipment, and they provide 2,047 global maintenance.
Is that a huge service component?
Yeah, the source material explicitly mentions that Ciena is seeing great services opportunities with these neoscalers precisely because these companies need a trusted partner to execute incredibly complex physical programs.
It's outsourcing the physical complexity of hypergrowth. A neoscaler comes in and says, here's $1 billion. I need these 2 data centers in Ohio and Texas to talk to each other fast enough to train a trillion parameter neural network. Make it happen and don't let it break.
And when you're burning millions of dollars a day just in electricity to train an AI model, the cost of a network failure is catastrophic.
You literally can't afford a subpar optical connection.
No, you buy the absolute best, most reliable, highest capacity system available. This dynamic is what supercharges Ciena's pricing power and drives that nearly 45% margin.
So Ciena is capturing the hyperscalers who are upgrading and the neoscalers who are outsourcing their entire build-out. But this raises a fundamental technical question.
Okay.
If the market is doubling to $50 billion and everyone is frantically building new data centers, what exactly is the physical problem they're trying to solve?
Yeah.
Why can't we just use the existing internet infrastructure?
Well, this brings us to the core physics problem of artificial intelligence, and it requires a completely new way of thinking about how computers talk to each other.
Let's dig into the source data on this. The executives noted that AI requires massive data transport for 3 highly distinct phases: model training, data ingestion, and inferencing.
Right.
But the CEO made a really fascinating observation about the current state of the industry. He stated that right now, compute power, meaning the actual GPUs processing the math, is highly constrained by physical location. Therefore, in his words, the network has to go to the compute.
That phrase, the network has to go to the compute, represents a tectonic shift in data center philosophy. Historically, if you were building a massive cloud service, you'd find a huge plot of land, build one colossal data center, stuff it with 100,000 servers, plug it in, and run your operations from that centralized hub.
The mega warehouse approach.
But AI broke that model. Training a state-of-the-art AI model requires a volume of electricity that is difficult for the human mind to comprehend. We're talking about data centers that draw gigawatts of power.
Which is insane.
It is. You simply cannot find a single municipal power grid that can support that kind of localized energy draw anymore. You can't put a gigawatt data center in downtown Manhattan or Silicon Valley. The grid would just collapse.
So because you can't find enough electricity in one place, you're forced to split your supercomputer apart.
Yeah.
You build one data center in North Dakota where there's cheap wind power, another in Texas near a natural gas plant, and maybe another in Iceland near geothermal.
Exactly. But here's the catch. To train a single unified AI model, those 3 geographically separate data centers have to act as if they are one single machine.
And that is the latency death spiral.
Yes.
Because if a GPU in Texas has to wait for a piece of data to arrive from North Dakota before it can perform its next calculation, it just sits idle. And when you have a cluster of 50,000 GPUs that cost $30,000 each, an idle microsecond represents an astonishing destruction of capital.
It is the enemy of AI training, latency, the delay in data transmission. And this is governed by the immutable laws of physics. The speed of light in a vacuum is roughly 300,000 kilometers per second. But when you shoot light through a glass fiber optic cable, it slows down to about 200,000 kilometers per second.
So no matter how good your software is, you can never transmit data faster than 200,000 kilometers per second through glass.
Right. And since you cannot make light travel any faster, the only way to solve the latency problem and keep those GPUs fed with data is to push vastly more data through the fiber at the exact same time. You need immense bandwidth and density.
Which brings us to Ciena's marquee announcement in this earnings call, the introduction of a technology called the RLS HyperRail. This is multi-rail intelligent line system that Ciena actually co-created alongside the hyperscalers.
It's an engineering marvel designed specifically to solve the distributed compute problem we just outlined.
To give you the specific data points from the call, HyperRail is designed to support multiple fiber pairs in parallel over distances of hundreds of kilometers. It utilizes highly advanced optical amplification, which results in significantly higher density and vastly improved space and power efficiency.
Let's translate that technical jargon into a physical reality.
Please do.
In traditional optical networking, a line system is the heavy equipment that physically fires the lasers down the glass fiber. But glass isn't perfect. As light travels over miles of fiber, the signal degrades, gets fuzzy, and loses strength. That's a concept called optical dispersion.
Okay.
So the line system also includes amplifiers placed every so often to catch the fading light, clean it up, boost its power, and shoot it further down the line.
Right, like relay stations for light.
Historically, these systems utilized a single rail, meaning they managed one primary path of light.
Let me try to use an analogy here to visualize the leap HyperRail represents. Imagine traditional fiber optic transmission is a high-speed, single-lane bullet train carrying cargo between two cities. It's incredibly fast, but it can only carry so much cargo at once.
Good analogy.
The new HyperRail system isn't just building a faster train. It's essentially stacking 10 bullet trains directly on top of each other, running them in perfect, synchronized parallel, and doing it without requiring a wider track or 10 separate train stations.
That is a phenomenal analogy. It perfectly captures the concept of density. Because space inside a modern AI data center is the most expensive real estate on Earth. Every square inch is optimized for servers and cooling systems. Furthermore, every single watt of electricity is precious.
Right.
The hyperscalers cannot afford to dedicate massive amounts of floor space or electricity to bulky networking gear. HyperRail allows them to push a profoundly larger volume of data over hundreds of miles without increasing the physical footprint or the power draw of the networking equipment.
And the market response to this has been immediate. The source material noted that Ciena has already secured the industry's first multi-rail order from a leading hyperscaler. The executive advisor, Scott McFeely, described it as a massive multi-year deal worth hundreds of millions of dollars. And that is just for this one specific new system.
What's fascinating about this is how the product development cycle worked. Ciena didn't sit in a vacuum, build a cool new laser, and hope someone would buy it.
Right, they went straight to the source.
Exactly. They sat in the secure engineering war rooms with the biggest tech companies in the world, looked at their highly confidential AI training roadmaps for the next 5 years, realized the underlying physics of the network were going to break, and custom-designed HyperRail to prevent that collapse.
That level of trust between a supplier and a hyperscaler is profound. It's a true symbiotic partnership. And the financial impact of HyperRail for Ciena is spectacular. McFeely noted that the revenue from HyperRail will begin to ramp linearly starting in 2027.
Yeah.
But he used a very specific, deliberate phrase when discussing its impact on profitability. He called it a step function elevation in margin accretion for the company.
A step function. In mathematics and economics, a step function isn't a gradual sloping curve. It is a sudden, sheer staircase straight upwards.
Wow.
The traditional single-rail systems Ciena sold already possess strong profit margins. But because HyperRail delivers such disproportionate, immense value to the hyperscalers by saving them physical space, scarce electricity, and millions in idle GPU compute time, Ciena is able to charge a premium that structurally elevates the profitability of their entire product portfolio.
It's the ultimate corporate win-win. The cloud provider saves billions of dollars over the life cycle of their AI models by achieving perfect compute efficiency, and Ciena captures a massive chunk of value they created in the form of elevated gross margins. But while dominating the long-haul connections between cities is incredibly lucrative, the source material reveals a second, perhaps even more aggressive strategy.
Yeah.
Ciena is no longer content just connecting data centers on the outside. They are actively invading the space inside the four walls of the data center.
This represents a major strategic expansion and, honestly, a declaration of war against some of the legacy networking giants.
How so?
Historically, the demarcation line was clear. Ciena owned the vast optical pipes between the buildings, the metro, and long-haul transport. But the internal wiring, the routing, and switching inside the data center itself was the protected domain of other massive tech conglomerates.
Like Cisco or Arista.
Right. But AI is rewriting the rules inside the building, too. The data from the earnings call shows that Ciena's routing and switching business grew by a staggering 88% year over year. That is an organic growth that is taking massive market share.
And this explosion was largely driven by a specific product suite called DTOM, which stands for Data Center Out-of-Band Management.
Right. And out-of-band management is a critical concept to grasp if we want to understand how a data center survives disaster.
Okay, walk me through that.
Think of a data center as having a primary nervous system, the massive optical networks carrying the actual AI data, the petabytes of user information. But what happens if that primary network crashes? What happens if a core router goes offline and the servers lose connection?
Where you can't just send an engineer to walk down miles of server racks to physically unplug and restart a single server.
Exactly. You need a secondary, completely parallel, totally independent network to access the servers and fix the problem. That is the out-of-band network. It's the emergency red phone for the network engineers. It has to be utterly reliable, completely separate from the main data traffic, and always on.
And apparently, Ciena built a radically better red phone. According to the source, DCM combines traditional routing and switching with something called PON technology. PON stands for passive optical network, and the adoption curve is steep.
Very steep.
Meta is the anchor customer for this DCOM solution. But Ciena also secured orders from a second unnamed hyperscaler and is currently in the qualification phase for a third. They estimate the total addressable market for DCOM alone could be between $1 to $3 billion by 2029.
The integration of PON technology inside a data center for out-of-band management is a stroke of engineering genius.
Why is that?
To understand why, you have to look at the legacy architecture. Traditional out-of-band networks rely on massive, thick bundles of copper Ethernet cables running from specialized management switches down to every single individual server rack.
It sounds messy.
It is worse than messy. It's a physical liability. Millions of copper cables take up an immense amount of physical space. They're heavy, but more importantly, they physically block the airflow inside the building.
Oh, right.
In an AI data center, keeping the GPUs cool is a matter of life and death. If you have waterfalls of copper cabling blocking the cooling fans, you have to spend vastly more electricity on air conditioning to push the cold air through the obstruction.
So how does a passive optical network solve this?
It replaces all that active copper with a radically simplified architecture based on light. A passive optical network uses a single strand of fiber optic glass coming from the main terminal. But instead of needing an electrically powered switch in the middle of the room to route the signal to different servers, it uses an unpowered, passive optical splitter.
Interesting.
A prism, essentially. It splits the light beam and sends it down multiple paths to the individual server racks.
So the word passive literally means it requires zero electrical power in the middle of the network.
Precisely. You eliminate thousands of intermediate, power-hungry switches. You replace massive bundles of thick copper with incredibly thin strands of glass. It dramatically reduces the physical cabling footprint, completely removes the power draw of the intermediate switches, and clears the airways for vastly improved cooling efficiency.
And when you're a hyperscaler like Meta, running a network of data centers containing millions of servers, saving even a tiny fraction of power and a few degrees of cooling on every single rack aggregates into astronomical operational savings over a year. That explains why Meta jumped on this as the anchor customer. But DCOM is just their beachhead. They're driving even deeper into the components inside the server rack.
Right. The deeper you go into the data center, the closer you get to the actual compute chips.
And that brings us to pluggables. The source material notes that Ciena is seeing phenomenal demand for their interconnects and pluggables, specifically their 400G and 800G modules.
Yeah.
In fact, they're on track to double their revenue from pluggables by 2025. And they just won a major contract with a major switch OEM, incorporating their WaveLogic 5 and WaveLogic 6 nanoplugs.
Let's define pluggables for the listener. A pluggable is exactly what it sounds like. It's a tiny, highly complex optical transceiver module that literally plugs directly into the faceplate of a server or a network switch.
Okay.
Its job is to take the electrical signals generated by the silicon chip and translate them into optical light signals that can be shot down the fiber optic cable.
So it's the translation engine between the world of electricity and the world of light. And WaveLogic is essentially Ciena's proprietary brain inside that pluggable, the digital signal processing chip that orchestrates that translation.
Yes, and as the speeds increase, moving from 400 gigabits per second to 800 gigabits per second, and soon 1.6 terabits per second, that translation process becomes incredibly difficult. The physical tolerances shrink to near atomic levels.
Which perfectly sets up the most fascinating and frankly riskiest part of their data center invasion strategy. Let's talk about the Nubis acquisition. Ciena recently acquired a specialized company called Nubis Communications, bringing two highly experimental major assets in-house.
This is huge.
The first is a technology called Nitro. Nitro is described in the call as a linear redriver, and interestingly, they refer to it as a silicon model that is performing extremely well. The second asset is called Vesta, which is an optical engine designed for co-packaged optics, or CPO.
Co-packaged optics is widely considered the holy grail for the future of AI data center connectivity. This is where the laws of physics are truly forcing our hand.
Why is it the Holy Grail? Walk me through the physics of what happens as we try to push more data through a standard server motherboard.
Imagine the inside of an AI server. You have a massive AI processing chip, like an NVIDIA GPU, sitting in the middle of a green circuit board. Historically, when that chip wants to send data out to the network, it sends an electrical signal across a few inches of copper wiring printed on the circuit board until it reaches the edge of the board where the optical pluggable translates it into light.
A journey of maybe 3 or 4 inches across copper? Seems simple enough.
At traditional speeds, it is simple. But at the frequencies required for modern AI, 800 gigabits per second and beyond those few inches of copper become a catastrophic bottleneck. At those extreme frequencies, a copper wire begins to act like a radio antenna. It radiates energy.
Oh, wow.
The electrical signal degrades massively over a distance of just a few inches.
So the signal gets fuzzy before it even reaches the edge of the board.
Exactly. To compensate for that signal loss, you have to pump a tremendous amount of electrical power into the chip just to scream loud enough for the signal to survive the 3-inch journey. That excess power generates an incredible amount of heat.
And heat destroys silicon.
Yes. So you need bigger heat sinks, more powerful fans, liquid cooling systems. The entire architecture of the server begins to buckle under the thermal load.
Okay, so the core problem is that traveling even 3 inches over copper at AI speeds melts the system. What does Vesta, this co-packaged optics engine, do differently?
Co-packaged optics eliminates the journey. Instead of putting the optical translation engine at the edge of the circuit board, CPO brings the tiny lasers and optical components and literally packages them directly onto the exact same piece of silicon substrate as the main processor chip.
So it puts a laser right next to the brain.
Right next to it. The electrical signal travels a fraction of a millimeter before being converted into weightless, heatless light. The power savings are astronomical. The thermal load drops dramatically. It fundamentally removes the copper bottleneck from the server architecture.
That is mind-bending. The optical network is essentially dissolving into the microprocessor itself.
It really is.
And what about Nitro, the linear redriver?
Nitro solves a related problem. In architectures where you can't use co-packaged optics right away, you still have to deal with that degraded electrical signal as it travels to the edge of the board. A linear redriver is a specialized piece of silicon that sits on the circuit board, catches the degrading electrical signal halfway, cleans up the noise, amplifies it, and pushes it the rest of the way. It's an electrical relay station that requires very little power.
Okay, I understand the incredible technology here, but here's where I want to push back on the business strategy. This sounds incredibly risky. For decades, Ciena has built its empire selling massive, highly protected, fully integrated hardware systems. Big metal boxes that route light across continents. By moving down into the microscopic level, into components, into pluggables, and selling actual silicon models like the Nitro chip, isn't Ciena stepping into a highly commoditized, brutal knife fight of a market?
It's a fair point.
The component layer is notoriously cutthroat, right?
Yeah.
Plagued by thin margins and constant undercutting by overseas manufacturers. Why invade the data center if it means fighting in the mud?
It is a totally valid concern, and it goes right to the heart of the debate over economic moats. The executives address the strategic shift directly during the call, and their defense of this strategy is a masterclass in market positioning.
Okay.
Let's tackle the margin question first. The executive advisor pointed out that selling a silicon model, meaning Ciena, is licensing the proprietary chip design or selling the raw microscopic silicon rather than a heavy assembled metal box, actually offers incredibly high growth margins.
Wait, really? Higher margins than the big systems?
Yes. Because when you sell a silicon model, you completely strip away the heavy physical manufacturing costs. You don't have to buy sheet metal, you don't have to assemble power supplies, you don't have massive shipping and logistics costs associated with moving heavy freight around the world.
Ah, so a silicon model behaves almost more like an intellectual property business or a software licensing model. The cost is almost entirely in the upfront R&D, so every subsequent chip sold is pure profit.
Precisely. But the larger, more existential defense of their moat comes back to vertical integration. The executives argued, and the market data supports this, that Ciena is the most deeply vertically integrated supplier in the entire optical industry.
Meaning they do it all.
They design and control the core technology at every single layer of the stack. They design the base silicon chips. They design the pluggable optical transceivers. They design the heavy metal routing boxes. And they design the global software orchestration platform that manages all of it.
They own the entire alphabet from A to Z.
Right. And this vertical integration provides a dual shield. First, it means they aren't just a generic component vendor who can be easily swapped out for a slightly cheaper alternative. Their components are highly optimized to work within their larger systems. But more importantly, the moat protects them from attacks from below.
What do you mean from below?
The executives noted that while Ciena is successfully moving down the stack into components to capture more market share inside the data center, the component vendors find it nearly impossible to move up the stack into the systems business.
Let me see if I follow. A company that makes cheap lasers in Taiwan might try to steal Ciena's pluggable business, but they can't possibly steal Ciena's core business of connecting cities.
Right.
Because building a good laser is hard. But building the software, the intelligent routing algorithms, and deploying the 247 global service network to manage 1,000 lasers across the floor of the Atlantic Ocean is a totally different and possibly expensive beast.
Exactly. The moat around the systems business, the complex software, the global service teams, the massive integration capabilities is so incredibly deep and wide that a standard component manufacturer simply cannot cross it.
That makes total sense.
So Ciena has the freedom to launch aggressive attacks into the component space inside the data center with their advanced tech, knowing their core multi-billion-dollar systems business is completely insulated from those same component makers.
It is a massive multi-layered pincer movement on the data center. They own the pipes outside the building, and now they're systematically taking over the wiring inside the building.
Yes.
But as fascinating as the hyperscalers and the data center architectures are, there is another massive story hidden inside this earnings call that almost no one is talking about.
Yeah, let's get into this.
While all the headlines are focused on Meta, Google, and the neoscalers, there is a secondary explosion happening in the legacy telecommunications space. Let's move to the sleeping giants, the service providers and MOFNs.
The traditional telecom operators. This is perhaps the most unappreciated dynamic in the entire AI infrastructure narrative.
The legacy service providers, the AT&Ts, the Verizons, the British telecoms of the world. While everyone is hypnotized by the cloud giants, these traditional telecom operators are quietly fueling a massive secondary revenue boom for Ciena.
Absolutely.
Let's look at the hard data from the transcript. Service provider revenue for Ciena was up 28% year over year. In the context of legacy telecom, which normally grows at a sleepy low single-digit pace, a 28% jump is a seismic event.
And the source material provided a very clear historical reason for this sudden, violent spike in capital expenditure. For the past 5 to 7 years, these telecom operators have systematically underinvested in their core optical infrastructure.
They just took their eye off the ball.
Completely. The CEO explicitly stated that the telecoms were entirely preoccupied with the massive multi-billion-dollar capital expenditures required for the global 5G cellular build-outs.
All right.
They spent all their available capital and all their engineering bandwidth putting new radio antennas on cell towers. To fund that 5G war, they neglected the optical fiber buried in the ground.
I see. So they built these incredibly fast wireless networks for our smartphones, but they ignored the wired backbone that connects all those cell towers together.
Exactly.
But now the 5G build-out is largely complete. The antennas are mostly up, the massive capital cycle is tailing off, and right at the exact moment they look back at their core optical networks and realize they're severely outdated, the AI boom hits and demands exponentially more bandwidth.
So they are trapped in a frantic existential game of catch-up. They have to rebuild their core optical backbones to handle the traffic generated not just by AI, but by their own 5G towers. That alone explains a large chunk of the 28% growth.
But there is a second, even more fascinating dynamic at play here between the telecoms and the cloud providers. Ciena operates a division called NDS Network Design and Services, and the data shows that NDS revenue specifically from service providers completely doubled year over year, a 100% growth rate.
Unbelievable.
And the executives noted this was primarily driven by something called MOFN, which stands for Managed Optical Fiber Networks. Now, I need some serious clarification here. What does this massive surge in MOFNs mean for the traditional telecom companies? Are they giving up their independence? Are they just becoming glorified landlords for the hyperscalers?
If we connect this to the bigger picture, it is a brilliantly symbiotic relationship born out of pure physical necessity.
Okay.
We talked earlier about the hyperscalers and the neoscalers, these massive, unbelievably wealthy cloud entities. The CEO referred to them as omnipotent in the software and capital realms.
They have unlimited money and unlimited compute power.
Yes. But even an omnipotent cloud giant has physical, earthly limitations. A hyperscaler might have $100 billion in cash, but they cannot magically wave a wand and dig 1,000 miles of trenches for fiber optic cables across 6 different countries.
That's true.
They cannot navigate the labyrinthine nightmare of local zoning laws, municipal regulatory red tape, environmental impact studies, and right-of-way negotiations for the last mile into thousands of different local jurisdictions.
The red tape is the real bottleneck. It doesn't matter if you employ the smartest AI engineers in the world or if you've invented the fastest co-packaged optics. If the city council of a small town in Ohio refuses to grant you a permit to dig up Main Street, your network stops dead in its tracks.
Precisely. The regulatory and physical friction of the physical world is the ultimate barrier to entry, which is exactly where the legacy service providers possess massive, irreplaceable value.
Because they've been doing it for decades.
They've existed for a century. They already own the right-of-ways. They already have the trenches dug. They have existing conduits under the streets. They have armies of lobbyists and lawyers who know how to navigate local regulatory approvals. They have the physical footprint in the ground.
So what happens? A hyperscaler needs a massive new network, but they don't want to spend 5 years arguing with city councils.
Exactly. The hyperscaler goes to a local telecom operator and says, look, we're building 3 new AI data centers in your region. We need a dedicated, massive, hyperfast optical network connecting them. We have the cash to pay for it, but you have the permits and the trenches. We need you to build it, lay a glass, and manage the physical infrastructure for us.
And that bespoke, custom-built network is a managed optical fiber network, a MOFN. The telecom company is building a private, dark fiber network explicitly for the exclusive use of the cloud giant.
Right. And here is the kicker. Who does the legacy telecom company hire to actually design the complex optical architecture, supply the bleeding-edge DWDM lasers, and physically integrate this massive new network?
They hire Ciena. That perfectly explains why the network design and services revenue doubled. Ciena is essentially acting as the master architect and the heavy machinery provider for the telecoms, while the telecoms are acting as the heavily permitted general contractors for the hyperscalers.
It creates an incredibly durable, multi-year catch-up cycle following the 5G era. The telecoms have discovered a massive, highly profitable new revenue stream building bespoke managed networks for AI giants who have unlimited capital.
Right.
And Ciena is sitting in the middle, happily supplying the picks, the shovels, the software, and the installation teams for the entire global operation. It illustrates perfectly how the raw demand for AI compute cascades down through the entire global economy, waking up these sleeping telecom giants and forcing them to modernize.
Okay, so as we take a step back and look at the whole board,
Right.
the demand profile is truly astronomical. The traditional hyperscalers are upgrading their entire architecture to HyperRail. The new neoscalers are outsourcing complete network builds to Ciena's services team. And the legacy telecoms are waking up, realizing their networks are obsolete and ordering billions in gear to build MOFNs.
Yep, it's coming from all sides.
Which leads us inevitably to the single biggest existential threat Ciena currently faces. And remarkably, that threat isn't a competitor releasing a better product. The primary threat is physics, logistics, and the global supply chain. This brings us to the final massive revelation in this earnings call: supply chains, backlogs, and what Ciena calls the value exchange.
This is the critical friction point where the infinite exponential demand for software collides violently with the finite reality of physical manufacturing.
Let's lay out the raw numbers from the transcript because they're staggering. Ciena's backlog, meaning the legally binding orders they have received from customers but haven't yet manufactured and shipped, grew by $600 million sequentially from just the prior quarter. Their total backlog now sits at a massive $7.7 billion.
To contextualize how large that is, Ciena's entire projected revenue for the full fiscal year is expected to be roughly $6.3 billion.
Which means they have more than an entire year's worth of total corporate revenue just sitting in the waiting room, fully booked, waiting for parts.
And the CFO provided even more granularity. He noted that of that $7.7 billion total, about $6.4 billion is purely physical hardware orders, as opposed to software or future services. And crucially, they expect to manufacture and deliver 80% of that hardware backlog within the next 12 months.
But delivering $5 billion of complex optical hardware in a year? requires navigating a heavily constrained, highly fragile global supply chain.
Absolutely.
The executives explicitly mention ongoing constraints around very specific components, specifically laser pumps for their optical amplifiers and advanced modems. Now, their vertical integration, building their own silicon components, obviously provides a buffer against some of this chaos, but they are still being forced to spend massive amounts of capital just to guarantee they can get raw parts.
Right. They announced they're spending between $250 million and $275 million in capital expenditure this year, and a significant portion of that is dedicated simply to securing supply chain capacity from their vendors.
Let's be clear about what that means. Ciena is essentially acting as a bank. They are financing their suppliers, giving them cash to build more factories or add manufacturing lines, just so those suppliers can produce enough raw laser brinks to feed Ciena's massive backlog.
That's exactly what's happening.
But I have to ask the deeply skeptical question here, because anyone who has watched the tech hardware space over the last 5 years has seen this exact movie before, and it usually ends in disaster. Yep. I want to compare this $7.7 billion backlog to the great toilet paper hoarding panic of 2020.
The phantom order phenomenon.
Exactly. During the COVID pandemic, every company in the world panicked about supply chain shortages. So if a company needed 10 network switches, they ordered 30. They double ordered or triple ordered from multiple different vendors, just hoping that someone would deliver something.
Yep, we all remember that.
It created these massive, artificially inflated backlogs that looked like endless years of guaranteed revenue for the hardware companies. But it was a phantom backlog. And when the supply chains finally unsnarled, the customers look around, realize they had warehouses piled high with unused gear, and instantly canceled all their pending orders. Yeah. It caused a massive revenue crash across the hardware sector.
It was brutal.
So with everyone in the world screaming for AI hardware, how do we know this $7.7 billion backlog isn't just an AI mirage? How do we know these aren't just panicked hyperscalers double ordering equipment they will cancel next year?
It is the single most important question for any investor, analyst, or observer of this industry right now. Because if that backlog is phantom, the 40% growth narrative collapses entirely.
Right.
And the CEO, Gary Smith, alongside the CFO, addressed this exact fear head-on during the analyst Q&A. They were adamant that these are absolutely not COVID-era phantom orders.
Well, every CEO says their backlog is real. What is their actual proof?
Their proof lies in a unique structural advantage we discussed earlier: visibility. During the COVID hoarding era, companies were just ordering generic hardware boxes and stockpiling them in dry warehouses. The manufacturer shipped the box and had no idea what happened to it afterward.
Right.
But remember the neoscalers and the telecoms. Remember Ciena's massive network design and services division, because Ciena isn't just shipping boxes because they're actively architecting, installing, bolting, and managing these networks on behalf of the hyperscalers and the telecoms. They have direct, real-time visibility into the end destination of every single laser pump.
Oh. They know the equipment isn't sitting in a dusty warehouse somewhere because Ciena's own engineers are the ones physically standing on the data center floor, bolting the gear into the racks and turning it on.
Exactly. They have total closed-loop visibility into the deployment cycle. The executive stated emphatically that they are seeing zero order cancellations. They are seeing zero requests to push back delivery dates. In fact, the dynamic is exactly the reverse. The CFO remarked that if Ciena possessed a magic wand and could instantly manufacture and deliver all $7.7 billion of that hardware backlog tomorrow morning, the customers would take delivery immediately. They are desperate to get that infrastructure out of the boxes and into the ground so they can turn it into revenue-generating AI compute power.
The demand is completely insatiable. But because that demand so vastly outstrips the physical capacity of the global supply chain, Ciena finds itself in a remarkably powerful negotiating position. And this leads to a strategy the executives referred to as the value exchange. This might be the most brilliant piece of corporate maneuvering in the entire earnings call.
It truly is a masterclass in how a dominant technology company leverages a temporary supply constraint to fundamentally, permanently improve its underlying business model.
Walk me through how the value exchange actually works in practice. Because Ciena possesses the exact optical gear that everyone desperately needs to build their AI empires, and there isn't enough of it to go around. Ciena is literally sitting down with some of the largest, most powerful tech conglomerates on Earth and renegotiating the fundamental terms of their relationship.
Right. And they aren't just bluntly jacking up the price of a switch, although the CFO did openly acknowledge that strategic price hikes are absolutely on the table. The value exchange is much more sophisticated. They are exchanging their guarantee of physical supply for structurally better business terms across the entire contract.
What kind of terms?
Imagine Ciena executives sitting across the table from a major cloud provider. Ciena says, "Look, we know you desperately need these specific advanced optical amplifiers to launch your new AI data center next month. We control the supply. We will guarantee you get those amplifiers. But in exchange, we need to optimize the product mix you're buying from us. We won't sell you just the cheap, low-margin components you have to buy the full, high-margin software and service package as well. Furthermore, we need to renegotiate our payment terms. Instead of paying us 90 days after delivery, you agree to pay us in 30 days.
And because the cloud provider is losing millions of dollars a day if that data center doesn't open, they agree to the terms. This perfectly mathematically explains that cash conversion metric we discussed at the very beginning of the deep dive. This is exactly why their cash conversion cycle improved by a massive 20 days.
Exactly. They're utilizing their immense leverage in a constrained market to force the biggest companies in the world to pay them faster.
Which generates that massive $219 million in free cash flow, which Ciena then turns around and uses to invest in their own supply chain to secure even more raw materials, which allows them to guarantee more supply to the next hyperscaler, allowing them to extract even better terms. It is a perfectly engineered, self-sustaining, virtuous cycle of profitability.
And it ensures that as Ciena scales up its manufacturing base to meet this unprecedented generational AI demand, they are growing profitably, safely, and entirely on their own terms. It explains why management possessed the confidence to actually raise their financial guidance for the entire fiscal year, despite navigating what is objectively a chaotic global supply chain environment.
So to pull all of these complex threads together and summarize this massive deep dive, the Ciena Q2 2026 earnings call is not just a story about a company selling routers. It is definitive, incontrovertible proof that the artificial intelligence boom has breached containment. It's no longer just a software phenomenon restricted to coders in Silicon Valley. It's a profoundly physical, heavy industry transformation on a global scale.
The bottlenecks limiting the future of AI are no longer just about writing a more efficient algorithm. The constraints are physical space inside a building, the thermal dynamics of copper, the availability of electricity on the municipal grid, and the speed at which we can force light to move data between distributed compute clusters spread across continents.
And from that rapidly expanding $50 billion total addressable market to the parallel optical lanes of the new HyperRail system to physically invading the inside of the data center with out-of-band PON technology and co-packaged optics, Ciena is positioning itself to capture immense value across every single millimeter of the physical data journey.
That's well said.
They're proving that when the world undergoes a structural change this violent and this fast, the companies providing the fundamental physical infrastructure, the high-tech picks and shovels, are the ones holding all the real leverage.
And we hope this serves as a powerful reminder to you, the listener. The next time you open up an AI tool, the next time you casually ask a large language model to draft an email or analyze a complex data set, take a moment to realize you're not just interacting with a clever piece of code floating in the ether.
You're really not.
You're actively relying on this exact, invisible, heavy metal infrastructure. Your simple text prompt is triggering incredibly complex laser pumps. It is utilizing advanced optical modems. It's traversing the dense multi-lane fiber pairs of systems like HyperRail, and it's entirely dependent on the physical reality we just unpacked today.
It radically grounds the seemingly infinite magic of artificial intelligence into the very finite physical reality of the Earth we live on. But looking at the trajectory of this infrastructure also leaves us with a fascinating and frankly provocative final thought to ponder as we wrap up.
I'd love to hear it.
As these foundational AI models continue to scale exponentially, demanding training runs that are orders of magnitude larger every single year, they're forcing data centers to be built further and further apart. You simply cannot find a gigawatt of spare electricity in one city anymore. But as we stretch these massive distributed supercomputers across hundreds or even thousands of miles, we are inevitably on a collision course with the immutable laws of physics.
Very true.
Light can only travel so fast in a vacuum, and it travels even slower in glass. And even with brilliant space-saving innovations like HyperRail or co-packaged optics, a physical strand of glass fiber can only hold a finite amount of data before the light begins to distort, or the fiber itself literally melts under the intense energy.
It's a hard limit.
So the ultimate question is this. In 5 or 10 years, when the speed of light itself becomes the final unbreakable bottleneck for the growth of artificial intelligence, what radical new physics or completely alien network architectures will we be forced to invent next?